What if I told you that while everyone's distracted by the stock market and crypto, gold just broke a record $4,000 an ounce, an all-time high that's quietly leaving other investments in the dust? If you're holding cash or just indexes, you might be missing out on the biggest wealth protection move of the year. Here's the real question. How much money are you letting inflation and uncertainty steal from you by not holding any gold right now? In the next few minutes, I'll break down exactly how gold outperformed nearly everything else, up 49% this year, why $33 billion flooded into gold exchange-traded funds in a single month, and the 3 key reasons gold may be the only true money that stands up when everything else wobbles. Ready to see if you're protected or if you're at risk of getting left behind? Let's get into it. Before we jump any further, quick disclaimer. This video is for educational purposes only and is not personalized investment advice. Investing always involves risks, including the risk of law. Past performance never guarantees future results. Always do your own research and talk to a professional advisor about your unique situation. Let's cut through the noise by laying out a simple, clear framework for what's truly happening with gold right now. Here are the 3 big reasons gold just hit $4,000 an ounce, and what that could mean for your money. Plus, I'll walk you through common gold myths, including Bitcoin versus gold, and share what I'm doing personally, so you can walk away with a smart game plan. First, let's look at performance. Gold is outpacing almost every asset. Gold shot to $4,000 an ounce for the first time in history. And this isn't just a blip on the radar. According to recent market data, gold's up 49% year to date. Let that sink in. Since January, an investment in gold would have grown by nearly half your starting value. Meanwhile, the S&P 500, the darling of most portfolios, managed only a 14% gain over the same period. And Bitcoin, even with all its wild swings and headlines, gold still edges it out. At least when we look at year-to-date returns. Real estate, dead slow by comparison, as tightening rates and affordability issues have kept price appreciation subdued. To make this super clear, here's an apples-to-apples chart of key assets. Year-to-date, gold up 49% and S&P 500 up 14%. Real estate much lower. Regional median data shows near zero to low single-digit appreciation. Bitcoin, lagging gold's percentage gain this year. This means if you started with $10,000 in gold at the beginning of January, you'd now be sitting on roughly $14,900 versus $11,400. You'd stuck it in a standard S&P 500 index fund. When you zoom out, the numbers become even more valuable to understand. Why does this matter? Because if your goal is simply to protect what you already have, not shoot for home run returns, but defend your purchasing power, the numbers say gold has quietly been the best defender so far this year. And here's the kicker. These returns have happened alongside, and some argue because of, slowing growth in the broader economy. But performance isn't the only story here. Second reason, global tidal wave of institutional gold buying. If the returns have your attention, what the biggest investors on the planet are doing might make you rethink your own portfolio. Let's talk about the central banks and institutional flows fueling this surge. According to World Gold Council data and Bloomberg reports, central banks across the globe have massively increased their gold reserves since 2011, but it's especially accelerated in the past 3 years. Here's what's actually happening and why it matters for everyone. If you go all the way back to the year 2000, global central banks were net sellers of gold. They were dumping it. But after the global financial crisis, the GFC, around 2010 to 2011, that trend reversed. Suddenly, these monetary authorities recognized the risks building in fiat systems and began buying up gold instead of selling it. From 2011 forward, they've quietly been loading their vaults, and according to charts from the World Gold Council, the last 3 years have seen the steepest increase in gold buying for decades. Recent numbers are jaw-dropping. In September alone, $33 billion flowed into gold exchange-traded funds, the largest monthly inflow ever recorded. That's not just mom-and-pop investors. That's major institutional money and hedge funds, not to mention sovereign wealth funds, voting with their dollars. Or more accurately, voting against dollars in favor of gold. Even Morgan Stanley, a global banking giant, recently announced they're now allocating 20% of their own model portfolios to gold, the first time ever. Historically, most mainstream institutional portfolios kept 2 to 10% precious metals, so a jump to 20% signals enormous conviction or enormous worry. On the retail side, more Western investors than ever are buying gold directly. US and European gold dealers report record transactions. Here's your progress marker. So far, we've covered how gold is beating other assets and how the world's largest financial players are betting on it. But are you still wondering why all are happening now? That brings me to the third key reason: macro backdrop. Inflation, stagflation, and faith in dollars is shifting. Let's get into the heart of it. We're now in what economists call a stagflation environment. That means growth is stalling, sometimes even negative, but prices are still rising. That's traditionally the situation where gold and silver historically outperform all comers. Let's examine why. As central banks, especially the U.S. Federal Reserve, started cutting interest rates back in September, investors anticipated lower yields on traditional dollar-based assets, making gold, an asset with no yield, but also no default risk, much more attractive as a store of value. Meanwhile, the U.S. dollar, for decades, the world's reserve currency, is getting questioned more and more. Central banks appear to worry about dollar devaluation. Investors, big and small, are looking for shelter from the loss of purchasing power that inflation brings. Just think, in the last year, the U.S. dollar's value, adjusted for inflation, has slipped enough that every dollar buys noticeably less. It's no wonder the flight to safety is on. Let me add a curiosity loop here, because in just a second, I'm going to bust the biggest myth people have about gold versus Bitcoin and other new money assets, so stick around for that. But right now, the point is this. The reason everyone from Morgan Stanley to central banks and retail savers like you are rushing into gold isn't just price or performance history. It's the realization that paper money systems, currencies that can be printed at will, carry a built-in risk of losing public trust. Gold, by contrast, can't be created out of thin air by any government. Its supply is finite. The rules can't be rewritten on a whim. Even industry leaders like Citadel's Ken Griffin are sounding the alarm. Griffin recently said the current rush into gold actually worries him, not because gold itself is risky, but because it may signal fading trust in the U.S. dollar as a global safe haven. I now view gold as a safe harbor asset in a way that the dollar used to be viewed. That's what's really concerning to me. Remember, just a little over a year ago, gold was sitting at $2,200. Now it's at $4,000. When someone of Griffin's stature shifts their focus from dollars to gold, you know the ground is moving for everyone. Micro call to action time. If you're worried about inflation, eating your savings tap so I know I'm not alone. And so YouTube shares this with more people who need to see it. Now, curiosity time. If $33 billion flooded into gold exchange-traded funds in 1 month, there must be a reason. But does buying exchange-traded funds really count as buying gold? That's what most pros miss. Here's my honest take. An exchange-traded fund gives you financial exposure to gold prices, but not the asset itself. That's why I always recommend, if you're looking for true downside protection, consider buying at least some physical gold or silver. It's not an either-or conversation. You can do both. But remember, exchange-traded funds may only be paper claims. In a real currency crisis, physical ownership is king. By the way, if you're looking to buy gold, I personally use AppMex. The link's down below in the description, if you click that. I do get a small commission, but you don't pay extra. I only recommend what I actually use myself, and I want my community to have transparency. Quick progress check. We've now covered gold's outperformance, the wave of institutional demand, and why that demand is rising due to the macro factors shaking everyone's trust in fiat currency. Stick with me, because next, I'll bust a big myth about gold and explain how a simple allocation could help buffer your own portfolio. Pattern break coming up. Let's jump into the myth-busting round. Isn't Bitcoin or the S&P 500 better than gold? Myth-busting. Isn't Bitcoin or S&P 500 actually the superior play, you might be thinking? But Ray, Bitcoin and S&P 500 have crushed it, too. Why not just stick with those? It's a fair question. And here are the facts. Bitcoin has had astronomical returns over longer periods, no doubt. If you bought at the right time, the upside's been life-changing. I did well there myself because I bought early. But here's what the world's largest players are doing. Central banks aren't loading up on Bitcoin. They're not loading up on the S&P 500 index either. They're buying gold massively. That's a big clue. Why? Because gold proves over and over to be less about making you rich, but more about keeping you from getting poor when currencies wobble. Or as I like to say, gold isn't about getting rich. It's about not getting poor. And here's another fact. Not all boosts are equal. The S&P 500's 14% gain this year disappears fast if you translate the returns back into gold terms rather than dollars. That's the unseen risk. What looks like a gain in your brokerage statement can actually be a loss if inflation and dollar erosion take their toll. Quick micro call to action while that's top of mind. Do you have any gold in your portfolio? Comment yes or no below. I genuinely want to see how common direct gold ownership is in our Ray Invests community. All this brings us to action. How should normal investors, or anyone watching Ray Invests, think about their own gold allocation? There's no one size fits all. And this is where risk and diversification come into play. Morgan Stanley, introducing a 20% gold allocation to their models is historic. But that doesn't mean it's the right number for you. The old rule of thumb in the personal finance world is to consider between 5 and 20% of your portfolio in gold or precious metals, depending on your appetite for risk, your other holdings, and your outlook on inflation versus growth. Want to be more precise? I put together a free goal checklist for you. A simple download that'll help you figure out if your portfolio has enough protection or needs some tweaks. The link's below and there's no sign-up required. Let me get more personal here for a second. Personal story and real numbers. My own gold experience. I first bought gold at the end of 2017, maybe early 2018. I can't remember the exact date, but I remember the feeling. I paid about $1,200 for my first ounce. Now, that's a lot more than some old-timers who tell me they bought in for $50 or $100 back in the day. But look at $1,200 versus $4,000 today. That's more than tripling my original purchase. And it's been the steady, confidence-boosting part of my portfolio through all the shocks. COVID bank collapses, Bitcoin bubbles. For me, gold and silver have proven to be true money, not just another asset. Yes, I also rode the Bitcoin wave early. I can't argue with the numbers. But at today's valuations, I'm not racing to add more. Central banks, the experts with trillions at stake, aren't loading up on Bitcoin. They're making their biggest gold moves in decades. I think that says something. Let's pause. Think about your own exposure. Is your money too tilted toward assets that depend on faith in paper currency and policies? Or do you have real, tangible value as an anchor? These are the questions that matter most when economic tides shift. Engagement prompt. What worries you more? Inflation, currency collapse, or a major market crash? Drop a comment with the one that keeps you up at night. A few final thoughts as we near the end. Is now the best time to buy gold? Here's the honest truth. When something's at all-time highs, it's never the perfect time to buy. The real perfect time was always yesterday. But gold is unique among assets for one reason. You can't just print more. There's a limited global supply, and what exists is what we have. No central bank can change the rules on that. That scarcity is what drives gold's role as it borrows money across 5,000 years of history. Are there risks? Absolutely. Gold doesn't pay dividends. Or kishpo, its price can drop sometimes dramatically. Don't take expert predictions at face value. Some say gold could hit $5,000 this year, but nobody, myself included, can guarantee the future. Always spread your risk. Never put all your eggs in one basket, and consult a licensed advisor for your specific plan. Quick pattern break. If you ever want to watch shorter takes or quick market updates, check out my Ray Invests Clips channel, which I post to regularly. Links in the description. I'll always keep making in-depth content here, but if you prefer 4 to 8 minute bites with charts and stats, that's where they'll live. Final recap. And one more value piece coming right up. Here's the bottom line. Gold doesn't promise you wealth. It protects what you've earned, especially when the money system itself feels uncertain. That's why $33 billion poured into gold exchange-traded funds in just a month. Why central banks and even Morgan Stanley are making their biggest gold moves ever. And why your own protection plan deserves at least a hard look at what gold can do for you. Download my free gold allocation checklist below if you want a practical step-by-step on how much gold could make sense for your unique risk profile. I only wish I'd had something like this back in 2017 when I was just starting out. Not financial advice, just sharing the game plan and tools that have helped me and my Ray Invests community feel more confident even when the headlines look scary. And if you haven't already joined my free newsletter, make sure to sign up using the description link. It's where I regularly share my portfolio moves, case studies, and market data right as things happen. Not just on YouTube. That's our roadmap. If you stick to that framework, compare asset performances, watch what institutions are doing, and question your own risk balance, you'll always be ahead of the next panic headline. If you made it this far, I appreciate you. Let's keep building your financial safety net, one smart move at a time. Now, if you want a deep dive, go watch the video on screen. It dives into another core asset that could change your financial future. See you over there.